Everybody, welcome to this TreasuryONE Finance Ghost Fireside chat. We're going to look into the markets. There's a few developments that happened over the past month or two. Some volatility in the currency that we've always seen happening. Up to 19, back to 17.40, back up to 19. Obviously, there's a lot of questions out there from everybody, and we look forward to tackling some of your questions that you may arise. I'm going to hand over to Finance Ghost quickly to do an introduction. So
Thank you, Wichard. Morning, Andre, and morning to our attendees. So it's the first time we're trying this fireside chat, and basically all that means is you still have the brains on the call in the form of the TreasuryONE team. I'm here to just facilitate it and make sure no one hurts themselves. And what we're doing differently here is instead of a sort of pre-baked presentation, this is very much just a Q&A. So we'll see how it goes. We'll see how long it goes on for. But obviously, get your questions into the chat sooner than later. Don't wait, because there is nothing to wait for. We are straight into the Q&A. We did receive some questions ahead of time. Obviously, I have some as well. So I'm going to kick it off. But please don't be shy. Send those questions through. So the first one is around China, which is obviously always topical. And I guess the question here is, how does the slowdown in the Chinese economy affect other emerging markets, especially South Africa? And I just want to add to that and say, we researched UPS this week in Magic Markets, and obviously that's the biggest logistics company in the US. And it was interesting in their international business to see them talking about a stall in the Chinese recovery story. So yeah, it's always nice. I love taking what companies are saying and comparing it to what the macro picture looks like. So over to the team. What is the story? It's almost like that Tim Cook email. I don't know if you saw that on Twitter. He basically sent a one line. It was something like, China, what's happening and what are we doing about it? So that's the question here. What is happening with China?
Thanks for that, Finance Ghost. Hi, everybody. Let's start off the China discussion just by saying let's have a bit of a background of what's happening in the Chinese economy. We all know that the Chinese economy was the growth engine of the world in the past 10 or so years. And that's directly after the great financial crisis of 2008. There was a massive push to have infrastructure spending, and that was mainly achieved through debt. As we all know, as I read about it in the last couple of days, this debt was sort of should have been a one-stop or one-time fix, just to get this Chinese economy going. But as we all know, that sort of just became like abused the fiscal side of it. And local governments just kept on getting or asking for funds to build infrastructure like roads, airports, ports, you name it, they went gung-ho on it. And after a while, well, that in 10 years' time, the way that Chinese are building, they will run out of roads to build and airports to build, but they've got this massive amount of debt. Just in that same time, we had the COVID situation in China, where they had 3 years of a zero COVID policy. That sort of stalled the Chinese economy. Nobody was buying houses. Everything was sort of slowing down a little bit. But with that, there was a massive amount of spending in the COVID zero policies as well by these local governments. So they've got a double whammy where they had debt from the infrastructure spending, and then they've got debt from the COVID zero situation they came out of. What that basically meant is everybody thought this is going to be a great recovery. China will be, after they opened up earlier this year, they will have a fantastic start. They will have a running start and everything will be hunky-dory. That didn't happen quite as much as we thought. If you look at the property sector, that's 30% of their GDP, and nobody is buying property in China anymore. So every local government that used to benefit from people buying land, suddenly they've got a bit of a budget deficit there because people aren't buying any land or anything. So they're running into liquidity problems. They are strained, and people are looking to the central government to fund them. And the Chinese premier came out and said that he's not very keen on doing massive stimulus because he wants a Chinese economy that is more technological driven and self-sustaining rather than using debt to fund their GDP. But back to the property side, that's 3% of their GDP. So you can see that's a massive amount of their GDP. But why are they slowing down? Basically, the demographics have changed in the past couple of years with COVID. There's a huge youth unemployment problem in China. I think the last one is 21%, but they stopped printing the number going forward. So more people are staying at home rather than being first-time home buyers. If you look at the birth rates and marriage rates, that's also gone down. So people looking for bigger houses, that's also down. So that demand slowdown just creates a snowball effect in the property sector. And with these massive amount of debts and the repayments that can't be done, that sort of shifts a bit of focus to the Chinese property sector, and people are getting wary of it. One thing that they didn't realize out of the COVID thing is that even though the Chinese got a massive amount of savings, there's a bit of consumer cautiousness just because of the 3-year lockdown. Nobody's spending money on houses, cars, or furniture, luxury items. They are sort of waiting to see what's happening with this whole COVID situation. That leads to a lack of demand. That lack of demand snowballs into possible deflation, and the Chinese economy is stalling quite. I want to say, if we say stalling, it's going to be below 5%. We wish for a 5% growth rate, but in the Chinese economy, that is seen as a slowing down of the Chinese economy. Now that we've got this backstory of why the Chinese are where they are at the moment, what does this mean for South Africa? Well, with demand destruction or lack of demand, South Africa is a big exporter to the Chinese in terms of raw materials, commodities. That will take a hit. That will influence our trade accounts and current accounts, which would not look good for the rand going forward. In terms of if we see the slowdown happening, that will just sort of would be the tailwinds for us to be going into recession if China slows down, and that the first initial part of that will be a bit of rand weakness. We also have to see, with the lack of confidence currently in China, with all the stories, all the data that's coming out that's a bit negative, that the rand is a proxy for all other emerging currencies. We've seen in the last couple of days that the rand has weakened quite a bit, and that could just be a bit of people taking a view of being risk off, seeing what the situation in China is before they go into emerging markets. I think that spillover effect into the rand will probably have it trade volatility for the medium term. But as you said, in the next 6 months, we believe that there's probably going to be a recession worldwide. And initially the rand could weaken, but as we go into the recession, when demand drops off locally as well, that normally is a signal for the rand to come back a little bit. I hope that answers the Chinese question.
Yeah, thanks. And I'm gonna add in quickly here. I'm gonna share my screen again. I shared it while I was talking about debt in China. But again, if you look at debt in China, you'll see they're running about 350% debt to GDP. So in South Africa, everybody's worried about we're running debt to GDP of close to 80%, 76%. They're predicting our debt to GDP is going to top out. China's running debt to GDP at 350% of their GDP. And you can see there on the screen here that corporate debt is a massive 225% portion of that. And that just goes back to the housing crisis that Andre talked about. It's massively leveraged in the housing. There's cities that are built in China for people, and people are just not buying it. So it's empty ghost cities that's sitting there in China. So you've seen the Evergrande story, county gardens. It's another problem at the moment in China. So the China's economy is just not doing well. Government debt isn't as high, and bank debt isn't as high, but overall debt in the China economy is massive. Just to add to that. Yeah, so
yeah, we shouldn't make Ghost City sound like such a bad thing. It sounds like quite a fun place to me. No, I'm kidding. But it's very interesting to obviously see how that plays out. I guess, and there are some questions starting to come through in the chat, and we'll deal with them now. But a linked question is, obviously China is very important from a commodities perspective. I think, Andre, you touched on the sort of exports, and we saw South Africa slip into a trade deficit. Obviously, I'm looking at the company news, and everything this year out of the mining houses has been production issues and load curtailment with Eskom, and all kinds of other things. I mean, obviously that's a contributor. To what extent can you delve into that trade deficit data and understand what the drivers are of that? I mean, is it that mining has come off? Is it other stuff? I mean, do we know?
Yeah, so we obviously we had a nice current account surpluses, and our trade balance looked very good. It was a function of the commodity prices that very well in like 2021, 2022. But you've seen prices. Let's look at the PGM. The PGM producers in South Africa is one of the major exports. So if you look, you can go to the Impalas and the Northams and the Bafokings and the Anglos. You can read all the PGM producers. They're all headline earnings per share is everybody's down. 20, 30, 40, 50, 60%. It's not. Northam took a 44 billion rand hit on their acquisition that they tried to do of Royal Bafokeng. I see in the latest, just before Impalas on the results, they did a 6 billion rand write down on the acquisition that they brought into the books of Bafokeng now. But again, if you look at rhodium prices, so in the beginning of COVID, rhodium was trading like at $4,000 per ounce. Then there was a massive shortage of supply in rhodium. There was a massive demand for rhodium. The rhodium went from $4,000 to $30,000 per ounce. So in that price, although it's a relative small portion of PGM producers, that produce like 4 or 5% of their basket is rhodium, it was a massive contributing factor to the revenue. Rhodium's come back to 4,000. Palladium was close to 3,000. Palladium is back at 1,200. Platinum is struggling at $900. You can go into the rutheniums and the iridiums. All those things are struggling. What's adding to the problems? Now, if you go over to the coal guys, you've all read about all the Transnet problems in the Richards Bay coal terminal struggling to get out. We've got all this production, they're producing it, but we haven't got reliable sources like Transnet to get the stuff out, to get it to the harbour, to get it on the ships, to get it exported. So all of that contributes to a trade deficit that we're running. Our terms of trades are narrowing, plus our trade deficit is contracting. The other side of the coin is our biggest import into this country is petroleum products, is fuel. And the oil price has rallied from $60 back to $85. So that's increased. So oil has increased, but all the other commodities has come back. And oil has increased because of production cuts out of Russia, production cuts out of Saudi Arabia. Everybody's just putting in production cuts. So our trade deficit isn't doing well because our biggest import is pricing is rising, and our biggest exports the pricing is decreasing. So the other problem is with mining profits that's coming out. The big long term down the line it's a problem for the fiscus again, because all of a sudden corporate taxes will be lower, so our tax collections will be lower into our next budget, which won't look good for the fiscus. It will put pressure on the fiscus. It will put pressure on debt to GDP. It will put pressure on our credit ratings again. So we'll put struggling to get the economy growing because all of a sudden the tax base is less. We've seen the end Tshwane where people are striking for more money. Tshwane government just doesn't have the money to pay for wages. So there's definitely a pressure cooker situation in South Africa, and it all starts with pricing, and you can just see how the spillover effects occurs from that perspective. I don't know if you want to add anything, Andre.
Yeah, my line of thinking was more, as you said, with the PGM basket prices that are down significantly from where they were in COVID. So, yeah, that's probably going to be the main reason.
Yeah, the reality is we managed to get through the pandemic as a country in much better shape than I think a lot of people expected. And it was just commodity prices, right? I mean, that's really what pulled us through. And those don't last forever. So there's a question in the DMs, which I think might be linked to that, which is, what is the main reason that Rand predictions in the start of the year were so far off? And obviously it depends which predictions you look at, of course, but I think there were some predictions running around in the market, that the Rand would end up very strong. And I actually managed to open that article while you guys were speaking, and it said there's, downside risk that it could reach almost 20, which is what's happened. Was China really the big negative surprise this year and commodity prices, or, was it a combination of that and load shedding and everything else?
So before we tackle that question, just to add on to the previous one about commodities, remember we had the commodity and everybody slowed down in COVID, and then there was demand, and then all of a sudden the Russian war also started, and that also helped commodity prices. We had like 2 events that helped South Africa towards commodity prices, just as a side note. But Andre, when I tackle firstly why everybody predicted it, it's not
the main thing to start off was, as you said, I think a lot of people expected China to be a lot stronger than they were when they opened up. People thought this was going to be like a little golden dawn of demand and everything's going to be peachy. That sort of didn't materialize. And then another thing that in terms of South Africa, it's there's just the own goals that we've been scoring of late. We had that Lady R story. Nobody predicted that. If you don't do a prediction, you can't predict for local own goals. And I think we once that sort of fed into the market, there was a bit of more risk premium in the rand. We also had the grey listing. So, and another thing that happened was that asset managers could take more funds offshore. We saw that happening quite big, or the amount that went offshore was quite a big amount quite quickly. So that just pushed the rand higher. A lot of things that sort of weren't foreseen. If I think it depends on how you look at your prediction, whether you talk your own. I don't want to say you talk your own book, but if things stayed as they were when you done the prediction, we'd probably have a stronger rand. But a lot of things happened that we couldn't predict in the past couple of months. I don't know if you want to add something before.
See, the other thing that what sort of added is everybody was expecting that in the beginning of the year that the US are not going to continue to hike rates. They thought the top of the cycle was in there, and they were predicting that the Fed's going to start cutting rates by like the next meeting, like September this year, they're going to start cutting rates. So again, if you start cutting rates and the risk premium in the US isn't as high as it is in the beginning of the year, the US was only like sitting at 4.25%. Now we're at 5.25% because we have all these interest hikes in between already. So where do you want to put your money? You want to put your money in at 5.25% okay, they've been downgraded, the US, Fitch downgraded the US, but you want to put your money at AA+ rating, or do you want to put it at BB- rating where your yield is only like 2.5%, because our interest rate differential between us and the US is only like 3%. So you want to put money in South Africa at 3% more than you can put in the US, or you want to put your money in a safe haven like the US. So it attracts, the US just sucks all the money because there's a lot of yield still there. So beginning of the year, everybody thought emerging markets still going to have higher rates. The US are going to start cutting rates because the economy is going to struggle, and then the dollar is going to be under pressure. That hasn't materialized. The US continues to hike rates, and you look at the Fed minutes that was released last night, they're still stating in their minutes that they're looking to continue to hike rates if inflation remains sticky. So inflation turned at 3% in June. We've seen the July number just came out at 3.2%, and they're expecting the second round of inflationary effects to come through out of the US now again. So again, higher for longer in the US, and the market is also only starting to price rate cut somewhere in 2024 now. So that's also been a turnaround. So remember in February we were grey listed. We had the Lady R issue. That's our own goals. We've got load shedding, massive amount of load shedding. We've got, if you add 2020, 21, 22 together, we've had more load shedding 2023 than those 3 years combined. So load shedding at that doesn't help the economy. So all those factors has put the rand under pressure. But again, by saying that, if we see the US at the top of the cycle and they're going to mention that they're going to start cutting rates, we do think that the rand longer term can recover, not because South Africa does anything well, just because the dollar will be under pressure from that perspective. And the reason I run up in the rand here is just because the dollar has had a massive recovery rally. The dollar index went from 100 back to 103.5. So dollar has had a massive rally. Euro's been under pressure. Aussie dollar is at a 1-year low at the moment. So Aussie dollar, which is also a commodity currency like South Africa, is also under pressure at the moment. So it just shows you, if you look at the Aussie dollar rand, that currency hasn't really moved. It's still sitting around 12 rand 20. From the rand, it was at 12.20 when the rand was at 17 rand 70, and now the rand's at 19 rand 50, and the Aussie dollar is still at 12 rand 20. It just shows you that the rand and the Aussie dollar has moved in sync with each other. So don't think it's just the rand, it's because of the dollar
that's very interesting. Of course, the common misconception in the media, right? The headlines scream about the South African issues, which are part of it. South Africa is a bit like the Ferrari Formula One team. We should do much better, but at some point we have to make a pit stop, and then you know for sure something is going to go wrong. So that's like Lady R or whatever it is. That's very much we are literally a whole country that is Ferrari's pit stop strategy.
Yeah. So again, just to add to that, so if you take out all our local risk premium issues that we have, the rand trades there's a risk premium built in. Fair value for the rand should actually be closer to like 15 rand to the dollar. We have fair value sitting more around 17 to 17.20. just because of all this inherent risk that sits in the currency. This ties with Russia, grey listing, where our credit rating sits. And the other thing is our political issues is not going to go away in the run-up to the 2024 elections. So volatility is going to be here to stay with us for the next 7-8 months. So this 17 to 19 moves that we've seen, it's possibly going to happen quite.
I mean, there's a question there around the mid and longer term outlook for the rand dollar over the next 6 months. But linked to that, I also want to ask, to what extent is there a psychological impact of going through, an 18 handle or a 19 handle? I mean, 20 is a bit of a crossing the Rubicon moment. Does it just become the new normal? Like, we all remember when the rand was $7 or $8, and it was horrifying when it went through 10. I mean, can you imagine 10? It's hard to believe that was once possible, and you see it in, I suppose, what happens something I just want to mention. I saw a great tweet, or X, who knows what it should be called. And it was about the number of cars that BMW and Mercedes were selling in South Africa 10 years ago versus now. And obviously these are premium imported vehicles, so they're expensive. And if you keep an eye on new car prices, you'll know full well that these days, just to drive a new 3 Series is like a R1 million car, if you spec it with anything really, which is insane. It was not like that. There was a time when the 3 Series and the C-Class were the top-selling vehicles in South Africa. Those days are long gone. Now we're seeing big growth out of the Koreans, the Chinese, Suzuki, and that's a direct result, I think, of stuff like the rand. So we just accept it. It's the frog in the boiling water issue. We look at this and go, oh, it's not so bad. It's 17. There was a time when it was 7. So I guess the question is, what is that mid and longer term outlook in your guys' view over the next 6 months? You've talked a bit about that, but maybe just to answer Glenn's question specifically. And then what is the psychological impact? If we go through 20, is that just the new normal?
Okay, I'll start off with the psychological impact, just in terms of it's strange in our industry where if the rand goes back to, I think we've got very short memories, as you just alluded to. We were back at 7, but we're sort of comfortable with the 17. When you're back down to 1740, everybody was saying, yes, the rand is quite strong. So I think, and it is not really, if you look at it, if you look at past history. So I think with the rand, a lot of people have got a very short memory, and if the rand comes back to rand, we think, geez, the rand's quite strong at the moment. But saying that, I think there will be a lot of dejected faces when the rand breaks through 20, and the possibility is quite real that it will do. And then what do we do after that in terms of, if it goes back to 18, we still go, we've got a short memory. 18 is not that bad. I think with psychologically, it will take some use to writing a 2 next to the exchange
Also in percentage terms, when you move a rand on 7, it's like what, a 14% move. Yeah. But you move a rand on 20, we're going to get to the point where you can move a rand and it's just like, oh, that was a slightly volatile day,
Exactly.
So 18 and 19. So if you approach that level for the first time, it's quite a big psychological level to break. So the first time we approached 17 rand, it was, we're going to break 17, we break it, and then we go, and then it struggles to go through it. It acts as that big figure, as we call it, acts as a resistance level. So 18 was tough, and the 19 was tough. But now we've seen we go through 19 up and down because we've done it before. So it's not a psychological level again. So I think if you want to go approach 20 will be a tough level to crack again, because it will psychologically be, we have never seen 20. It will be the first time. So it will be a tough level to crack. But again, as soon as you go through it, then you've done it, you've seen it, and Bob's your uncle. To answer Glenn's question, longer to medium term, we still think 6 months down the line, we still expect the US are probably going to start cutting rates in the economy. SARB will only start looking to cut rates towards the latter half of 2024. So our interest rate differential premium will open up a little bit. So we still think 6 months down the line, we'll see the rand trading at better levels, sort of between back to like 1720, 1730, around there where we were just 3 weeks ago. Believe it or not, we still think 6 months down the line we will be back there. We've lost 10% in the question of space of 3 weeks. We think we can recover that again in the 6 months. But like I say, there's still a lot of inherent risks and volatility in the lead up to the election.
It's still a Neville's question, because then I want to start to talk a little bit about inflation and interest rates while we have time. So his question is, obviously this is really hard, right? I mean, if we knew these answers, it would be easy. But maybe to the extent you can answer the $1 million question, or £1 million or €1 million, which foreign exchange currency, or which foreign currency, I suppose, would you see being the strongest over the next 36 months? Euro, pound, dollar, or Swiss franc? I mean, taking all bets here. It'd be interesting to get your views.
If I had a short answer, I would probably say the US dollar. Just looking at what's going on in the euro economy, whether they're going to start growing again. If you look at demographics in the eurozone, there's not a lot going for to get the economy going. The pound has got an inflation problem. They're probably going to be a little bit hiking their rates a bit longer. The US dollar is seeming the best off currently. It might change in the next 36 months, but just looking at that, I would say the old adage of buy dollars where diamonds is probably true at this stage. I don't know about you, Wichard.
No, sort of. The world economy is gonna struggle. The dollar will probably remain. It will be under pressure as soon as they start cutting rates, and if they're first or second, depends. They will be under pressure for a bit. But I think if you take a longer term 3-year outlook, I still think I agree with Andre. I think the dollar will still be the best performing currency. There's obviously another, just to add on to that, is there's a lot of talk about the world that want to move away from the dollar as the reserve currency of the world. Yes, it is possible that we can move from the dollar as a reserve currency, but it won't happen in the next 36 months. It's going to at least take a decade or more to get that done. 62 or 63% of the world's reserves at the moment still sits in US dollar. And then if you add the euro reserves, like 88% of the world's reserves, currency, savings, and all of that sits in the eurozone and the dollar. So for someone like a Chinese yuan to become the reserve currency of the world, it's a massive amount of work to be done. Remember, the dollar is the reserve currency. Everything is priced against the dollar. So for someone like Brazil to say they're going to import oil from China and paying them in yuan, it needs to go through another method if they don't want to go dollars. Otherwise, you've got to go from Brazilian real to dollar and from dollar to yuan to get Brazilian real to yuan trade. So they'll use gold and need something else to get it done. So just as a side note, we still think 3 years down the line, the dollar it will take a bit of punishment when they start cutting rates, but 3 years down the line, I think
very much dollar bills, y'all. So that's the one to remember. That's fine. And look, while you guys have got the crystal ball out, may as well finish off on energy, because there's a question there. And Derek, we will get to your question, but I think let's do it at the end because it's a bit more in terms of product. Andrew asked, can you make any predictions on energy and specifically the oil price? And then at least I think we call it a day on predictions and we talk through a few more concepts that I want to get through.
That all depends on supply and demand. I think if the world recession happens in the next 6 months, demand will be down, and probably oil prices will come down a little bit. But with the monopoly that the OPEC countries have, once the demand goes down, they will just cut supply again, and that they want to keep oil prices as high as possible. So I think if it was purely supply and demand driven without any cuts, it will probably be a little bit lower. But I've read somewhere that the oil guys like the price in the $80 level. So I think it will probably stay around here. I don't want to make a prediction, say we won't go above 100, but they like the prices where they are at the moment because they're making quite a big amount of money.
Okay, perfect. Wichard, do you want to add to that?
No, I agree with Andre. We don't think oil prices are going to drop dramatically to like $40 or $35 a barrel, even $20 a barrel that we saw in COVID. We are probably between $65 and $95 for the next 12 to 18 months. That's sort of with a range that we see the oil prices play in. I think as soon as oil drops below like $60 a barrel, I think a lot of the guys that produces the oil struggle to do it profitably at those type of levels. So that's why you see as soon as it drops, the Saudi Arabias and the Russians, everybody just starts to cut production to get to complement for the slowdown and demand that there is. So longer term, yeah, like I said, I think 140 where we saw in Russia, I think that's maybe a little bit toppish, and if you see those levels, it's a good selling opportunity, but somewhere between like 65 and 95 for the 12.
Great, and then if you can just give us 5 stocks that are guaranteed to return 100% in the next 12 months, that would also only, yeah, look, I'm not greedy. We could just get 5.
Only 5.
Let's move on to the SARB. So inflation targeting, something I wanted to ask you is when they're making these interest rate decisions, and Standard Bank came out this morning and said that they expect it to be flat for the rest of the year. Nedbank said the same thing when they released results. So there seems to be a view in the market that we're at the top of the cycle locally. Keen to get your views on that, I guess, just to make sure everyone knows that. But, does the SARB only look at inflation targeting when they're making these interest rate decisions? Do they look at stuff like credit loss provisions at banks, pressure on local consumers? Do they take a more holistic view, or is it very much just inflation targeting and acting accordingly?
I'll tackle the first part. In 2002, the SARB started with the inflation targeting. The reason why we have the band between 3 and 6% is just so that the SARB has got a little bit of scope to play within that area. If it is in the band, they might, if something untoward, if there's a supply shock in the market, they've got some leniency within the band to act upon their monetary policy. It's not like if they between 3 and 6%, we're going to keep rates unchanged. They still have a bit of leniency if there's a supply shock. We also have to remember that the mandate from the SARB is price stability, and that also comes with currency control. They sort of back in the day said, well, between 3 and 6% is where the rand shouldn't fluctuate a lot or won't blow out, and it will still attract and there will be some price stability, and inflation won't be a problem for the average user. They also have got the mandate that they should do their policies to encourage growth, but as we've known in the past couple of years or so, that our growth has been anemic due to certain factors beyond the SARB's control. But whether there's a pool where people say, well, maybe we should shift the inflation band a little bit higher, so that will increase more. Our economy will grow faster if the inflation target band is a little bit higher. We've seen that in Africa, but I think.
I don't know what happened there. Andre was censored by the SARB.
Can you still hear me?
No, he's back. He's back.
I can hear you.
Just lost Andre there.
We got you now.
No idea what happens there.
Yes, he's back.
Any case,
no worries. So yeah, I think they take a holistic view until I think the last strike as well. I think there was a lot of pressure on them to hike 25 basis points, just because they thought that the US is going to hike rates as well, and they sort of keep track of what's happening across the pond. But I think a bit of humanistic nature went into the MPC there and said, well, the consumer is under pressure here, so let's not I could again just to not put the consumer under further pressure. So I think most of it is the inflation, but there's a bit of a humanist element to it as well.
Yeah, just to add, like Andre just said, I think they're trying to inflation targets in the main thing, but they're trying to do a balancing act, and I think they tried to, by the previous meeting, not hiking rates by 25 basis points as was widely expected. Try to do the balancing act to try and stimulate a little bit of growth. Try to look at the fiscus down the line that we spoke about earlier, that corporate taxes are going to be under pressure, and if they continue to hike, the economy is still going to struggle to grow. So they're trying to do a balancing act, but they can't be seen letting inflation run away. The only problem is at the moment is that's part of parcel while the rand's a little bit under pressure is the risk premium, the interest rate differential between us and the US is now a little bit smaller, so you will struggle to attract capital from that perspective. So they need to look at, do we just protect the rand? Do we just do inflation targets? So there's a lot of balls in the air that they watch about to see how do
it's
we
very much
manage
rock and a hard place, and again, the commodities kind of carried us through for a couple of years, but if that stops now, which it looks like it is, then it could get uglier. So I suppose linked to that is just the recent trend in South African consumer confidence. And again, I look at the company news and you can see it's in Cash Build, for example, which is really struggling at the moment. Ital Tile, also pretty rough, better numbers than Cash Build, but not good. And obviously this comes out in the South Africans are just not investing in their homes anymore. They're not building. And I guess consumer confidence is part of it. I think everyone at the moment is either trying to, semi-grate or emigrate, or at the very least just hang on to what they have, or maybe rent property to de-risk themselves, or moving to a complex for safety, and then you're not typically building on to a bigger property. Like, a lot of those trends are not great. But obviously some of them are consumer confidence. A lot of it's linked to interest rates. Are there consumer confidence trackers that you guys look at, and what has been the recent trend? I'm sure I can guess. What are you seeing there?
So if you look at consumer confidence, you can look at the business confidence indicator, you can look at the purchasing manufacturing indicators, PMIs. So all of that's negative. It's below 50 in South Africa. Some of it's at 42s, 43. So it just means it's contracting. There's not a lot of confidence in the economy. There's not a lot of confidence in our government. So all of those things is not looking good at the moment. And you've mentioned results. You look at Absa and Nedbank's results that you've talked about. You can see that loan provisions are up. You can see people are spending less on luxury products and trying to. The first thing people likely always spend money on is keeping a roof over their head. So you'll see, but even those credit loss ratios is up. So you can just see, and we can feel it in the economy. Looking at we serve as a broad-based burn of clients, you can just feel the economy is really, really starting to squeeze in 2023. And like I said, if you read the SENS announcement, you read the company results from the local economy, it's not looking good. It's funny if you read the US results that their companies is, well, a few of them are still doing good, others are still struggling, but they are actually still performing quite well. But if you look at the Eurozone economies, they've Netherlands gone into recession. Germany is in recession. So it's actually just America that's holding up a little bit well at this stage. They try to manufacture the soft landing. So, things are not looking too good in South Africa. It's not looking too good across the pond, except for America. But we still think there's pain coming in the US. In the
the numbers out of Home Depot, for example, are also not fantastic in the US. So there does seem to be a bit of an issue across the board. Sorry,
just to add, now you mentioned Home Depot and mentioning home. So the thing is in the US, okay, so their model on mortgages works a little bit different than it works in South Africa. South Africa, 95% of people that have home mortgages has got it at floating rates. So as soon as the interest rate adjusts, your interest rate adjusts as well with the bank, and you go up. Interestingly, in the US, it's all this 30-year fixed mortgage rate. So there's a lot of people at the moment, they've bought the house 5, 6, 7, 8 years ago. They fixed their mortgage for 30 years at 2%. All of a sudden, 30-year mortgages are sitting at close to 8%. So they've got there's no incentive for them to look to sell their property at this stage. So that reset of buying and selling properties and paying higher mortgage rates hasn't quite kicked into the US once again. If you look at corporate debt in the US as well, like 46 or 47% of corporate debt that only matures from 2030 onwards. So, and they've all been fixed at lower rates. So the pinch of high interest rates hasn't really been felt as much in the US as has been felt in the Eurozone, as has been felt in the UK, as has been felt in South Africa, because their banking model works a lot differently than the banking model.
Yeah, that's a great point. I mean, I've seen stuff online about how it's really tough to be an estate agent in the US at the moment for exactly that reason. And if you bought your property in the pandemic and you locked in rates at basically nothing, there is zero incentive to move, absolutely zero. And we're not seeing that in Europe in a lot of the property funds. Most of them are actually kind of struggling to just trade water. I mean, Nepi Rockcastle was a strong exception because Central and Eastern Europe is flying, despite what's happening in Ukraine. A lot of the others are dealing with these higher interest rates. I mean, the UK, if you go and chart that rate hike cycle. It's incredible. And that maybe leads me to the next question, which is, everyone at the moment is now talking about high interest rates and higher interest rates, and those two things are not the same. So higher just means higher than where we were, and high interest rates means high relative to, historical averages and what people are used to and what we've dealt with before. So it would just be good to understand, are we in a high rate environment now, or are we in a higher rate environment? Is this a lot versus historical levels?
So you want to tackle it, Andre?
No, you go ahead.
No, go for it.
I'll answer after you. No, go, your turn.
Yeah, so historically, South Africa, so if you just look at South Africa, we've seen interest rates in the early 90s at like 22 and 23 and 24%. So from that perspective, where we currently sit at 11.25%, it's still half of where it was in the 90s, early 2000s. But it's certainly a while away from the last 10 years where we've seen interest rates not at these unprecedented levels. So I think if we start cutting rates in South Africa, we'll cut it, but I don't think we'll see. I think our low was like 3.5% on the repo, 3.75 or something. I don't think we're going to go back to those type of rates. I think if you see the repo probably back to like 5.5%. Similarly in the US, they had the interest rates at 0%. I don't think we're going to see zero in the next 5 years in the US. They'll probably cut rates back to call it 2.5%, 3%. Same with the Eurozone. I think negative rates and zero rates, bar Japan, but again, they've let the yield curve control up a little bit higher. So barring Japan, I think we're in a higher. We're not going to be high forever, but we'll be higher than we were with the past decade for the next decade. I don't know what do you want to add, Andre?
I don't know. What I want to add is just back in the day, we were more in line with market forces doing the interest rate and all that. Now everybody's looking to the central bank to fix the current interest rate cycle. So I don't know what they've got left in their coffers if there's another bout of inflation and they have to do it higher and the world's still struggling after that. So I agree with Wichard in that it's going to be higher, and it's probably going to be higher.
That makes sense. So it's almost time to finish up. There's one more question that I want to ask you. It's a bit lighthearted, and then I think we can just quickly address Derek's question as well. So the lighthearted one is the good old Big Mac index. We actually had a really cool article in Ghost Mail this week about Big Mac versus Burger King and a lot of their guerrilla marketing. So maybe Burger King will come out with the Whopper index. That seems to be in line with their trend. But what does the Big Mac index say about, or rather, it says, I think you guys said to me before we came on here, the Big Mac index says the rand should be below $9, believe it or not. So, firstly, what is this lighthearted guide to currencies? For those who have never heard of it before, it's quite a fun thing. And then, why is it so deceiving as well?
Just on the Big Mac index, it's just basically what would a Big Mac cost in a country given what it would cost in dollars, how much would it cost in rands, or how much is rands, how much would it cost in dollars. So that just means that if the Big Mac is $5 and currently Big Mac is 45 Rand, that will be the 8 Rand or 9 Rand that the Big Mac index is at the moment. So it's just a purchase power parity index, and it's very tongue-in-cheek, and it was supposed to be a bit lighthearted, but a lot of people have claimed some sort of interest in it. And it's good for people who don't understand economics just to start off with a conversation. But if you really drill down into the details of the Big Mac index, there's a lot of things found wanting. First, it's just the principle of producer as price parity, and that is that the good has to be transferable over borders. Basically, it just means that whatever something would cost in USA, if you apply exchange rate to that's what it would cost in the other country if it had to transfer to the other country. With Big Mac, that that transfer of things overboard doesn't happen. Everybody creates their own Big Mac in their own country. A lot of things that are in a Big Mac is not part and parcel of the index. It can't be quantified in terms of that. And that would be, if you see there's a reason why a burger in Switzerland costs a lot more than a burger in South Africa. And that's just a non-transferable cost. That's wages, that's labor, that's their rent, and all that. If you look at Switzerland, their rent and wages are a lot higher than in South Africa. And I know McDonald's business model is it's the location rather than the burger. So all the spots that they choose are premium spots. So you can imagine the rent that you have to pay in Switzerland versus the rent you have to pay in South Africa. And that has to work into the Big Mac price. Also, another thing is just the availability of the food sources. I mean, if you go to a country that's got a lot of beef, like South Africa, that will probably bring down your cost. And if you've got a country like, let's say, for instance, Switzerland, where not a lot of people eat meat, they prefer chicken, there's going to be premium on the meat prices, so that will also drive the prices up. So it's not, there's a lot of things that the Big Mac Index doesn't take into account. Another thing is they don't understand currencies and just the way currencies work with interest rates and the political situation and the trade surpluses and all that. That doesn't get taken into account. And the last part that the Big Mac Index doesn't do is there's no regional differences that it takes account for. It's either, especially US is a good case for this, where a burger in New York costs a lot more than a burger in one nook with two fishes in Wisconsin or whatever. So what burger do they take for the Big Mac Index? But as I said, it's a good tongue-in-cheek thing just to sit around a fire and start chatting about this. But
basically, we should be thankful we have cheap Big Macs. I think that's what we should really be taking out of this, you know. Last question, and then I think we can wrap this up. So, and this is very much a sort of product question, but Derek asked, you know, what are the major costs involved in transferring a relatively small amount overseas, for example, 50 grand, besides the actual exchange rate at the time?
So the other costs involved is the exchange rate. It's obviously, you've got to time that, but there's a telegraphic transfer, TT cost that you need to pay. And that differs from bank to bank. So FNB will charge, let's call it 200 Rand, and Absa will charge 285 Rand, and Investec will charge 300 Rand. Depends from bank to bank about what their other charges is. They charge admin fee, they charge telegraphic transfer fees. All of those fees is separately charged to the exchange rate. So that's the charges you need to be involved in. It's not thousands of rands, but again, it's like some banks charge 750. Like I said, it depends who your bank is, what your bank status is. If you're doing it through us, the charges will be cheaper because we've got economies of scale. But if you do it just through your normal bank, they charges. So the other charge you're going to look off is admin charges and your telegraphic SWIFT charges that you need to
Great. Thank you, guys. I think we can leave it there. There's no other questions in the DMs. I'm pretty much done, and we've nearly used up the full hour. So I just want to thank everyone, I guess, for attending. And this is the first time we've done this fireside chat. So Keen, maybe you can just leave a comment quickly and just tell us, do you like this format? You know, is this something we should do again? Would you prefer it if we go back a little bit to a more formal presentation and then some Q&A? I personally enjoyed this a lot. It almost felt like a podcast. It was really nice to actually just keep it interactive right from the start. So Wichard, Andre, thank you so very much. I don't know if there's any closing views from you guys, or maybe just directing people to, you know, the TreasuryONE website, which I must say is looking fantastic. Brand new, gorgeous website. It really does look good. So well done on that.
Yeah, so anything is, I want to say, thanks for the opportunity to chat to everybody and just share a few thoughts out there. Like I said, there's volatility in the currency. Everybody's always worried about what's happening on the currency. There's going to be volatility in the currency. You got to strap in. There's still a lot of stuff that's going to happen. It's all going to depend on what happens, not just in South Africa, but what happens in the US. The US still remains one of the big drivers out there. So 6 months down the line, we still hope we're going to see we still think the rand's going to trade at better levels, not because South Africa does anything good, but because I think the dollar's going to be under pressure. The lead up to our election, like I mentioned, it's going to be a rough ride. It's going to be tough. So again, just apply good risk management policies out there. And if you've got any questions, anything that we need to attend, you've got our numbers and you can give us a call at any time, and we'll answer it. But thanks for attending. Thanks, Andre. Again.
Awesome. Thanks, guys. It looks like good comments there on
yeah.
this format, so we'll do one of these again. Everyone, thank you so much. And if you want to share this with your friends, we'll put this out on, it'll be on the TreasuryONE YouTube channel, and that'll go out in Ghost Mail, and you can happily share it around. Thank you for attending, and we'll do this again. Ciao.